Sorry for the interruption, guys. So welcome back. So we were continuing to solve the last problem of question number 11 under your Compendium of solved illustrations. I'll continue. So we concluded to say that property 1 and 2 are of the same class, used for the same purpose. Therefore, you cannot adopt different valuation techniques for subsequent measurement of these properties. Therefore, it is supposed to be recognized under the same technique. Correct? Guys, same. Yep, the stream is working fine. So let's look at and the property 3 is an investment property for us. Investment property cannot be subsequently measured as per revaluation approach under IND AS 40. IND AS 40 only restricts us to use cost approach for subsequent measurement. So revaluation approach is not a property. Not only these corrections, guys, we need also further corrections also. Look at it. The company does not depreciate any asset since the fair value is greater than the carrying value, and shall recognize the difference between the purchase price and fair value in the statement of P&L. Upward revaluation, you are not supposed to charge it to the credit of P&L. You are supposed to transfer it to the revaluation surplus account. In case the fair value is greater than carrying value, of an asset under revaluation approach, cost approach, it wouldn't have made any sense. Only if you are following revaluation approach, this makes sense. The difference should be transferred to revaluation surplus. Revaluation surplus or revaluation reserve, call whatever you want to, under other equity. It should be part of other equity. In statement of changes in equity, I'll call it as SOCE, guys. I'll talk about this in IND AS 1. What is SOCE? What do you mean under SOCE and how should it be presented? And not credited to P&L. Clear? This is the third rectification which I have to apply as far as this question is concerned, because he gave me a wrong treatment even for the revaluation surplus. Analyze the accounting policy. I have analyzed. Okay. And please advise the correct accounting treatment. What should be the correct accounting treatment? If I am following as per revaluation approach for both the property 1 and 2, guys, cost approach, revaluation approach, we have to take both of them. So I'll take first the cost approach and solve for all the three, and then I will take revaluation approach. Under cost approach, I'll only take into consideration the purchase price and the life of the asset. assuming that the residual value is 0. Okay, so 15,000, 10,000, 12,000, and life is 10 years each. If property 1 and 2 is if property 1 and 2 are measured as per cost model or as per cost approach, then in such case, property 1, 2, 3, what is its cost? The purchase price of these assets are 15,000, 10,000 and 12,000. 15,000, 10,000, 12,000. Their useful life is 10 years. Therefore, the depreciation should be 1,500, 1,000, 1,200. Depreciation per annum. Correct? Moving ahead from here, if I would have gone as per revaluation model, one second guys, is he asking me for any particular year? Nothing. So I'll just write it as depreciation per annum and leave it. At the end of which year, even I have no idea. So I'll leave it like this. But I'll also write down what is the carrying value at the end of the year. Carrying value at the end of the year is 13,500, 9,000 and 10,800. If I would have gone as per revaluation model for 1 and 2, property 3, there is no option. You will have to go as per cost model because it is investment property. If property 1 and 2 are subsequently measured under revaluation approach, in such circumstances where I start applying a revaluation approach for property 1 and 2, I'll have to compare between the fair value and the carrying value. Property 1, 2, 3 is only cost model, right? Cost would have stayed the same, 15,000, 10,000, 12,000. And their useful life, I already know the useful life as 10 years. But this 1 and 2 under revaluation approach should be compared with their fair values. Fair value at the end of the year. Look back to the question and check what is the fair value towards the end of the year. Market value at the end of the year is 16,000, 11,000, 13,500 is irrelevant because it is property 3 investment property. Only 16,000 and 11,000 are relevant for us. 16,000 and 1,000. In both cases, your carrying value is less than your fair value. No depreciation shall be charged. So depreciation per annum. In the first case, compare between fair value and carrying value. No depreciation, no depreciation. But for property 3, cost approach, 1200 depreciation. What is the amount of revaluation surplus then? Revaluation surplus will arise both in 1 and 2. First one, the case is 1500. Second one, the case is, first one, the case is 1000. Even second one, the case is 1000. Your fair value is in excess of the cost by 1000 rupees. Correct? That will be the revaluation surplus. Depreciation only on property 3 to the extent of 12. That will bring us to the end of the answer. The last question in your compendium of solid illustration. Cost model 13,500, 9,000 and 10,800. Revaluation model 16,000, 11,000 and 10,800. Absolutely correct. And that will bring us to the end of discussion regarding IND AS 40. We are done with IND AS 40. Discussion regarding the standard, the illustrations, workbook problems, certain additions in your study material in 2021. And we are also done with the compendium of solid illustrations. Comprehensively, you can keep your rest assured. You can be rest assured that you have done with 16, 38 and 40 in complete sets.